One of the major challenges to many business operators in this country is the cost of money, or if you like, the cost at which businesses borrow from commercial banks. And the reason, according to experts, is because the same private sector is competing with government for this money from commercial banks. Now, today we find out how this happens and what should be done to ensure that there is affordable credit for the private sector. The high-yield guarantee on Ugandan government bonds remains a major attraction of funds from banks, crowding out the private sector, which is equally in need of the same funds. The situation is worsened by the insatiable demand for funds by government to meet several shortfalls.
Most of the lending is, and the paper shows this, is a large part of it is going towards government bonds. Ugandan government bonds yield at least double than their counterparts in SADC and East African countries. And government bonds set the rate for cost of borrowing for a business or for a consumer.
Because of this situation, banks are today, according to experts, less motivated to bring down interest rates, with the commercial bank lending rates today averaging 20%, even as the central bank maintains its CBR rate at 7%.
It disincentivizes banks to grow their loan portfolio and find new greenfield projects to lend to. It increases bank aversion to risk because government bonds are risk-free.
With this state of affairs, even the central bank appears helpless.
If Kagwa, as through Minister of Finance, is borrowing at 15, and your CBR is at 7, and he's still borrowing, so whether you reduce CBR again, so long as Mr. Kagwa still has appetite, they won't respond. That's a fact. Because he sets the floor. That's what we have had. I think setting of the floor becomes instrumental. In days when we saw quick responses is where domestic financing needs were less compared to now, and therefore you reduce the bank rate, or so the CBR, there's liquidity, there is nowhere the commercial bank reported the liquidity, therefore it has to lower rates to get the customer.
All in all, the private sector, the main constituents targeted by commercial banks and indeed the ones that the central bank seeks to protect, it is a situation of despair, one filled with many unanswered questions.
The question again, if we are going to invite competition, is Bank of Uganda paying attention to the accumulating non-performing loans? And that is very important. If you are going to license banks here to come and establish, and even those that are here, to license them to renew their licenses again, are we asking the question, why are your non-performing loans this high? How is the loan management in this bank? How are we working with SMEs to ensure, and that's why we like Islamic banking, how are we working with SMEs to ensure that we bring down the risk of lending? Because that is your responsibility. You're a commercial bank, but you should also be a development bank in some way, because you have a responsibility to this economy. You're employing, it's very important for the Bank of Uganda to come out and say, look, we have licensed you to do this investment here, to do this business, but we don't want you to post 200 billion on your balance sheet, while everyone else, every time you open a paper, everyone else, a company is going under.
The commercial bank interest rates question remains a major point of contention between the borrowing public, the central bank, and commercial banks. As it is, it appears its answers might lie in policy and critical stances like government's stand on domestic borrowing, as opposed to being left to the demand and supply forces. Time now to take a very short commercial break. Man and Markets continues after this break.